I'm Wendy Moran, an assurance partner at McGowan Hurst Clark & Smith. Today, I'm going to talk about some specific examples and consideration for transportation and logistic companies when it comes to adopting the new 5-step revenue recognition model. Step 1 under the new model, identify the contract with the customer. Transportation and logistic companies may have verbal or written agreements or side agreements to contracts that could include cancellation or termination clauses, or clauses to provide customers with options or discounts. It's important to consider all of these factors when gaining an understanding of the contract, as these may impact the timing and accounting treatment of revenue recognition. Step 2, identify the performance obligations. Many transportation and logistic companies provide multiple products or services to their customers as part of a single arrangement. For example, a trucking company may store customers' goods in a warehouse before shipment. These may represent separate performance obligations which impact how and when revenue is recognized. Step 3, determine the transaction price. Common forms of variable consideration in the transportation and logistics industry include discounts, volume rebates, and performance bonuses. These must be separately assessed and accounted for under the new model. Step 4, allocate the transaction price to the performance obligations. Transportation and logistic companies may provide multiple goods or services to their customers as part of a single arrangement. Under the new standards, companies will need to allocate the transaction price to these separate performance obligations, which may require judgment and significant estimation on the part of management. Step 5, recognize revenue when or as performance obligations are satisfied. Transportation services are generally provided over a period of time and will most likely meet the criteria for revenue recognition over time, as the customer simultaneously receives and consumes the benefit as the company performs the freight service. The customer benefits from the company's performance as it occurs if another entity would not need to substantially re-perform the company's performance. For example, the distance already traveled. Any contract clauses that restrict a company from transferring its obligations to another company should be ignored during this part of the assessment. One other consideration for transportation and logistics companies relates to the gross versus net reporting of revenue. The new standard focuses on whether or not a company controls a specific good or service. Under the existing guidance, the focus is on assessing whether the company has risks and rewards. Companies will need to assess contracts from a control point of view under this new guidance, which could result in different recognition, gross versus net. The above are just a few examples of items that transportation and logistics companies should be mindful of when adopting the new revenue recognition guidance. Please see our other vlogs on revenue recognition for additional detail, or visit with your accounting professional or us here at McGowan Hurst Clark & Smith for additional information.